Hello, Illumination Wealth family. I hope you are doing well. It is March 9th, 2020, and that day has some symbolicness. March 9th, 2009 was the bottom of the Great Recession. You can't see it on the chart here because my head's in the way, but that is the exact day the market bottomed from a price of about 666 to what's now 2746 on the market. So there's been a powerful bull market over the past 11 years. And today, it's been a difficult day. It's been a difficult few weeks in the financial markets. Nothing that hasn't ever happened before in market history. And so, wanted to give a little bit of perspective as to what's going on with the coronavirus, with oil, as you probably heard of, and the global markets themselves. Because at the end of the day, why do we invest? We invest because it helps bridge the gap between where you are now and being able to achieve your lifetime of financial goals and dreams. Keeping your money in the safe haven of cash and bonds does not produce the returns necessary for you to fund the lifestyle that you want. And so we need to, as investors, understand that volatility is the price that we pay to capture great long-term returns. But nonetheless, as you can see on the chart here, we've had a couple difficult few weeks. And so thought I would step back a little bit because we've heard that the market was down pretty significantly over the past couple of weeks. But if I were to show you this chart and say, hey, look, the S&P is up 9.5% over a given period of time, you see this chart and you're probably thinking, wow, that's pretty good. And a balanced fund from Vanguard's up about 13%. Not too shabby, right? Well, what's the time frame are we talking about here? Thought I would share with you. This is from December 2018, essentially January 2019 through now, the market is actually up. So if we take a deep breath, give ourselves a little bit of perspective, despite what's happened over the past couple of weeks with the market decline, the markets are up over the past year, a pretty healthy amount. So just wanted to put that in perspective. Now, as we're talking about oil, there's obviously an oil war going on in the world between Russia and Saudi Arabia. And today's price drop was pretty significant. And it was a big impacting point for the market. You can see, historically speaking, it was one of the biggest one-day declines for oil. Now, that's going to have an impact because there's a lot of energy companies that that are part of the S&P 500 and part of the global markets. But it wasn't the worst one day in history. But lower oil prices have a positive side effect for us as consumers. Gas prices are going to be lower. There's going to be things that it impacts by having lower oil prices. So not all is negative, but certainly the impact was felt throughout the financial markets, which is why they probably had the decline they did today. But as we think about these big one-day moves and these big downward moves in the market that happen over short periods of time, if we take that perspective that I was sharing with you over the past 11 years and stretch it out even further, you can see how the financial markets, the stock markets, they reward discipline. They reward being a long-term investor. If you're going to be relying on money in the next 1, 2, 3, 5 years, you shouldn't be investing in the stock market. Investing in stocks and in real estate is something that is for the long term. And you can see all of the difficult periods of time that the stock market has endured and produced healthy returns for, from the Arab oil embargo, where the S&P dropped 50%, to the Black Monday one-day crash, to the savings and loan crisis, to the dot-com crash, to the Asian currency, to the Iraq war. All of these things, $1 invested in 1970 has turned into $59 through 2017, even more through 2018 and 2019. So a disciplined investor needs to look beyond the growth, the concerns of today, to the long-term growth of the financial markets. And we need to have patience. And I know it's a difficult thing to do when we're in a world that is social media driven and instantaneously accessible to everything. We need to step back and have patience to understand the long-term growth, the positivity of the US and global markets are going to reward us to have this type of discipline. And so we know that with the markets are down, people want to get out. They want to abandon ship. And fortunately, we haven't heard from really any of our clients to say, let's panic and sell. More about, should we be buying more and sticking to the plan of taking advantage of these lower prices? But here's a chart that goes back to 2018 that Vanguard provided that shows what happens that if somebody gets scared and they decide to sell low, waiting for the time to get back in, what would happen? And so this person, this is 2018, if you had $1 million of stocks and bonds, if on December 31st, the market started to decline, and after Christmas Eve, decides to sell because the market's really bad and we're going to wait to get back in, the returns over the next year and change would have resulted in a loss of about $60,000. Now, for the portfolio that remained fully invested after the drop, returns would have been 1.042 million. So you can kind of see that the market's never going to give the all clear signal. And that when it does decline, trying to get out and then figure out when to get back in, you're likely never going to do as well as just enduring it so that you can be the beneficiary of this long-term growth. Now, here's another example where you could see, somebody going to cash and then reinvesting soon thereafter did a lot better than trying to get out and time the market lows. We want to remain disciplined and understand that these short-term market movements do recover. And here's something that's, I think, really powerful to see. This shows how the market responds to crises. And this is a portfolio of 60% stocks, 40% bonds, so about 60% growth and 40% conservative. You can see all of these, market crash of 87, the savings and loan crisis, the dot-com crash, 9/11, 2008. After 3 years in about all of these situations, the market was higher. And 5 years later, the market was significantly higher in every single one of these crisis periods of time. So if that's the environment we're in, we want to use evidence to our advantage, not emotion. And I know these are, emotional times. It's scary and we feel it, but we also want to be mindful of what the facts are when we're investing and how do we participate in the fact that crisis actually leads to growth and opportunity. It leads to higher returns going forward in the future, and it creates the options and the opportunities for further growth. And this chart does a really good job of illustrating just the type of growth that you can expect by investing through crises properly. That's very powerful, investing through these periods properly. So now it's really about what can we control? And it's about having a plan that is designed to meet your goals and following it. It's making sure that you have a portfolio across multiple asset classes. It's about having multiple streams of income, not just one. How do you have multiple that help you produce income? If something were to slow down here, you have something over there. How do you make sure that you diversify globally? This not only means investing in your, in your local community, but investing outside of your local community, investing US, investing internationally. Having multiple assets reduces risk and increases returns. It's also about managing expenses inside your portfolio and out, being disciplined, living below your means, controlling taxes. And as an investor in the traditional markets, really staying disciplined through these market dips and swings. But taking it one step beyond there, how can you take advantage of opportunities like this? Because difficult periods in the market are creating opportunities to buy lower. You're able to buy things when they are on sale. You're able to now refinance your mortgage at historically low mortgage interest rates. So there's things that you can be doing that can be really powerful for your long-term financial health in these environments. So I welcome your conversation, welcome any questions that you have. Thank you for your listening, for your trust and support, and look forward to touching base with you soon. Take care.